rising construction costs, the material shortages, or labor costs, all of these, it makes total sense for people to go down the path of established properties rather than brand new properties, right? So people are deferring on building unless they really, really want to go down that path, right? And look, I mean, I strongly believe that I don't think that the build prices are going to come down ever. They've never come down. Like people have this weird sort of sense that, oh, you're going to see pre-COVID build prices again. I don't think that that's ever going to be possible. What is going to happen is basically the opposite of the build prices coming down. It's the established properties which is going to basically catch up. And so when you talk about trends, between established property, which is say 1 to 2 years old, versus a brand new property, on average, there would be about 20% difference between two. Okay, so established properties would sell 20% cheaper, and a brand new property would attract a 20% premium because it's brand new. Co-living properties can generate almost $140,000 in passive income and net of $40,000 in passive income after mortgage repayments, and they sit in an average yield of about 10%. Hello and welcome to season 3 for Help Me Buy Property podcast. Today we are talking about what is out there for property investment and Australian property real estate in 2025. We are going to unpack a lot of interesting things about interest rates, government incentives, rental market, population growth, migration, and banking changes. So stay till the very end. Now, before I kick off and talk a bit about and give you the recap for 2024, let's do a drum roll and bring Cheryl back. Miss Cheryl.
I'm so pumped and excited. I have a really, really good feeling about 2025. I almost feel like 2024 was prepping. We've had a really, tumultuous, challenging few years with interest rates at the max. I think it's good that we do a bit of a recap because sometimes you get so caught up in the everyday and what's happening in the market, you sort of forget where you started off and what happened, yes, which gives us a really good foundation of kicking into what we think the outlook is for the new year and sort of what the indicators are and so on. Shall we do a little bit of a around the world summary? Well, not the world. Australian property markets, of what we think, how 2024 went.
I think for me, 2024 was like amazing. Look, I mean, my dad used to always say, or he still says, that your tomorrow should be always better than yesterday, even if it's by 1%. So I'm super excited by 2025. But when you reflect back in 2024 or on 2024, people were expecting that it's going to ease up and the market is going to ease up and everyone was talking about it. And so people started buying a lot of that they didn't need. And there's this saying that it always resonates with me that if you buy things that you don't need, soon you'll have to sell things that you need. And when I reflect back and I look at like Christmas and New Year's time, and I was doing some of these data crunching, it's about $14 billion that was spent between Christmas and Boxing Day. And that's just amazing number. That's just a crazy number, right? And all of that number, 70% of that number was basically done on credit cards, which means people were expecting the rate cut to happen. People were expecting that there's the light at the tunnel that is very close. If you go back to 2024, interest rates were one place that was a sword to the eye. Everyone complained about it. Everyone thought that here's the pause, and then the next one came, and here's the pause, and the next one came, right? So that was one of the big things. And for people who didn't have their portfolio set up properly from a property investment perspective, they felt the burn, right? Those properties at 3% yield, 2% yield, where they were catching growth and not really focusing on cash flow, they started feeling the burn in their portfolios and their personal life as well.
Absolutely. And I've definitely seen that amongst the market and my peers around. I'm not sure if people, I think people did pull back on spending, discretionary spending. And I've seen that where people bought, particularly during, he said if they didn't quite do the right type of buying, particularly during COVID, right? People, if they were buying off the plan or whichever, and buying when interest rates were at some ridiculous lows, they're definitely feeling the burn of it. And I've seen people have to sell and intentionally held on to properties. Then they've had to cut back on more of the discretionary spending. There, what I found, they're not necessarily traveling overseas. They might be traveling internally, maybe, but I am seeing less of the spending on bigger items. Being people who generally like that instant gratification, we're still like, I still want to spend on food. I still want to do some like online shopping and things like that. So I think what you're probably seeing is more of the spending on lower value things. I'm pretty sure online shops like Shein and Temu and all that are absolutely busting because people still have this need to buy and spend something.
Yes.
Right? Yeah. But then they're going, what can I buy that's lower cost? And so that's why those online markets are doing so incredibly well, because people are still going, I don't have as much and I can't spend as much, but then I'm going to buy overseas or online, so I'm going to still be able to get my dopamine kick of spending. So I think there's more been a shift of consumer spending. Where I think there've been so many years of this sort of holding off. We're getting to the point where as consumers, we're wanting to do something. Right. And so I think it will be really, really interesting to observe what happens in this new year, whether people sort of still feel that level of negativity or are starting to do more of that local travel and buying, or what sort of triggers, because everyone's predicting some sort of movement this year. Thankfully, there wasn't too much last year, but they were like, something needs to happen. So I think that will be really, really interesting.
I think it's a very important point. Right? I think this shift in consumer behavior because of remote working and hybrid working models and people ordering stuff online. No one rocks up to Coles LD anymore. People are so complacent in ordering stuff and getting stuff delivered, right? All of these freight companies are doing quite well. So I think that is also quite evident in the real estate market, where you see smaller markets performing quite well. So cost of people not buying expensive properties, like Sydney contracted, Melbourne contracted, Brisbane to a certain extent contracted in major prime areas, right? But you look at smaller markets at 300 to 500 price point, just went berserk.
Absolutely.
Went crazy. Because naturally people could afford less, their borrowing capacity dropped. And so for people who are still looking for opportunities to negotiate better terms, to negotiate better prices, optimize their property portfolio, they started looking at smaller markets. And so that shift in consumer behavior was also there in the real estate market, where people started buying a lot of smaller stuff. The interesting point is this, right? When you're going out there and buying smaller, like I use Temu as an example, where you might not buy a Gucci bag, but you might buy 10 things that you want on Temu.
Don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages or off-the-plan properties or apartments. Get yourself a copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. This book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years, and there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in the property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book, it's easy to read, it has a lot of stories, it has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Moxin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book.
You would realize that you actually spend more, you don't spend less. And that was one of my findings, where when you look at the consumer spend patterns, 1.6% more spending than last year, like compared to in 2023. And so I think property is very similar, where people have said, oh, Jesus, this is like only $350,000 property. I'll take 3 of them. I'll be like, hello, you're over investing. They were hitting 6% yield. The portfolio is still negative because the interest rates are sitting at 6.5 to 7%, because plus there is other holding cost attached to it, right? So I saw that in 2024 as well, where people overstretch themselves. And I think good for them, because I personally feel that the best money is made in markets like this, where one is scared. You try to cut back your discretionary spending and go hard, and wait for the market to do what the market does, right? So
Yeah. Where do you think, and you talk about where the smart money is being spent? Speaking to a really good friend of mine, and we're talking about sort of what the herd mentality is doing, right? And he's not a big property guy. He's in business and so on. And he was basically saying, Cheryl, people aren't buying, and they're all waiting for the rate cut and everything else. And I went, well, if you're the herd, that's what you'll be doing. But the smart money is in buying now, right? Before everyone starts to move. And so, did you see much of that in 2024? What do you think the herd was doing, and what do you think the smart money was doing?
I think it very much depends on who do you network with, right? That's
True, yeah, that's
right. Like every day of 2024, every time I rocked up to an event, or I met friends or extended friends, or I was there to a community event, people would be like, oh, the market is so slow. Oh my God, the market is so terrible. Because all of these people live in Melbourne, right? And of course, I'm a Melbourneian. So I'd be like, where is it slow? Like it's crazy. You're buying in Perth, you're coming out of Perth, you're going back in Queensland. The market is just crazy. Like the days on market are the lowest that I've ever seen, like 6 days in market, 4 days in market. I've never seen days on market this low in some of these smaller price points, right? So I think the herd works in packs as well, where you talk about Melbourne and Sydney, people think that everything is collapsing in the world and this is what the doomsday look like. And then you look at astute investors and you hang around them, and the conversations that are happening in those circles are very different. Where people are like, okay, where are you buying next? And what are you buying next? And how do I find more money? And talking to those brokers and finding more money rather than sitting on the fence, like trying to enter in, right?
Yeah, absolutely. And so we can talk about then with the smart money going into 2025. So going back to 2024, let's talk about housing supply, right? It's always the big word in governments. We don't have enough housing. We need to build more. Where are you seeing sort of these housing supply constraints really quite prevalent?
I think 2024 people expected that some of this would settle down and it would see some less volatility around when you talk about material cost or labor shortages or constructions, etc. And because the demand was disappearing, right? What people realized that the building cost didn't come down, the labor cost didn't really come down. Government infrastructure spending kept happening in some of these major states like Queensland. And so the labor was still quite busy there. You still had mining boom continuing in 2024. And so a lot of labor was basically attracted to go there, which meant that from a builder's perspective or developer's perspective, the challenges were still there, especially in areas like Melbourne and Sydney, where the developers were just land banking. A lot of developers didn't had the braveness to go back into the market and build at 13-14% interest rates, because that's what equity markets were offering, and bank had zero appetite in entering or loaning, providing any sort of loan or support to some of these developers. And so a lot of that created not only slowness in the construction space, but also that imbalance between supply and demand, where there was nothing being built in the brand new space. Yes, there was off the plan being sold, but all of those projects were delayed by 2 years, 3 years, because people were just holding on to, or developers were just holding on to the bank providing them the funding and them hitting them off the plan sales, etc. But that put immense amount of pressure onto a rental market, pushing rents to record high in pretty much every state. You've never seen Melbourne delivering 5% yield, and you can see even parts of Victoria now sits at 5%. In Melbourne has typically always sit at like 3.5% yield. So that's how fast and the rents have gone up. Interestingly, the impacts of 2024 is not just in 2024. Some of this construction imbalance, some of these supply constraints would have follow-on impacts in 25 and 26, because even if a person decides to, as a developer, even if I decide to say, okay, I'm going to start developing this year, say start February, I'm not going to bring my stock out till in 12 months time anyway. So there are these implications, 12 to 16 months implications on supply side of things, whereas the demand keeps ramping up as the interest rates drop. And so there is this massive sort of implications on 25 versus 24. And so while 24 was a crunched year, it's interesting to see what the developers do in 2025. We'll talk about that when we talk about the outlook for 2025.
Yeah, and I'm keen to also sort of have a look into, well, what are the renters doing? They've been smashed with all these rate increases. Oh no, yeah, well, rental rate increases. And obviously feeling the pinch, going, goodness, I'm paying this much, I might as well pay my mortgage off. Rental market tightening as it is, and it seems to continue to do so. There's not a lot of supply, as you say, which is and I know last year as well, a lot of that sort of consumer behavior in terms of renters going, well, am I actually more open to renting sort of rooms instead? So because we talked a bit about co-living and rooming houses as well, how that space has absolutely grown immensely over the last few years. As well. So we can definitely chat about what we think about.
I think 2024 was definitely a year of resilience and patience for a lot of people. And people had to think on the feet in going out and creating more cash flows from their existing property portfolios. And so, of course, that's a very important point, that people started sharing rooms or started building grannies and diverting to those portable homes and see if they can create some value. I know this particular client where they stopped doing the traditional renting and put everything on Airbnb to create the cash flow for themselves, because every property that they had had an Airbnb potential. And so there were people out there who started taking a lot of risks as well, because they didn't want it to sell while sell was on the cards. They wanted to be even more contemporary, even take a slightly better risk in creating better cash flows for them. So interesting dynamics. Here we are in the first month of 2025. How is the year shaping up? Let's start there. How is 6 months?
What's shaping up for investors in 2025? Like I mentioned, this whole we talked about the whole. There's so many factors. I said affordability. People are looking for more affordability, and I get a real sense that people are looking more for lifestyle. This whole change in lifestyle, like less of the hustle. If we can work remotely, do we stay in where we are, or do we move further out or a different state? So you're seeing a lot of that. Yet tied into that is the people on the flip side, people who have moved interstate or overseas and had lots of flexibility. If they're working for someone and that particular business has said, actually, we need you back now, 60% of the time, how that's changed movement as well. And just looking, we've got interest rates, we've got rental markets. It will be really interesting to see what's happening in the lending, in terms of lending regulations, in terms of what the bank's policies are doing, and builds. So I think let's cover a whole range of that. There's so many key elements that I'd like to address this, because particularly with building prices, construction pricing, and are you finding people buying more new properties or established properties? Do you see that sort of happening? Is there much of a shift in the year?
I think people haven't really comprehended where the new build prices are, because there is not a lot of construction happening right now. A lot of people who have bought house and land packages, they've potentially bought it in 2022 and the projects have been delayed, or 2021 and the projects have been delayed. And so they've been locked in 2 years ago prices, right? I talk about single story build today and just give you, and you would know this, right? This is no new news for you. But for viewers and listeners, if you share a per square meter rate in today's market, and this is an investor grade product that we are talking about, no builder would touch a product for a single story build for under $1,800 to $1,900 per square meter. No builder. Okay. And these were the prices where you were building double stories about 4 years ago. Yeah, this is where the double story was being built at a much mid-end market, and we're talking about low-end market at that price point now. Okay, and so you talk about like almost 40% increase in prices from a build cost perspective, and I don't think that people have realized this. I was getting a quote for one of my own property because I was planning to upgrade, and I see a lot of my clients going through that similar dilemma of, hey, should we go out there and construct, or should we buy an established property? And they all come back to the same conclusion as to what I end up concluding as well, that it just doesn't make sense to build unless you're building in a much more contemporary fashion through importing stuff from China, etc. And so I feel that the market hasn't really responded to the build prices, and they haven't really seen the new prices. People are still hamstrung on these old build prices and have that mentality and mindset of, oh, I can build a 45 square meter house for $650,000 double story. And like, no, you cannot. It costs like $900 or $950 in today's market.
Yeah, and I think this is obviously more prevalent where if you're looking at established suburbs and looking at the replacement costs, because people like to live in established suburbs, and they go, all right, there's a nice old house here, I'm gonna knock it over and then I'll build a new house and then I'll be fine and dandy. And that's the part where people start to go, oh, is it going to be worth it? Because the value of the land has increased so much. And then once they put another house on it, then they've overcapitalized at that point.
Definitely.
And so being able to go, well, maybe I'm better off buying something established, probably renovating it a little bit, but then not overcapitalizing from that aspect. Not only that, when you're doing a whole new build, you're having to rent somewhere else again, right? And that's incredibly painful when you're paying skyrocketing rents, and then you've got a huge interest rates on your holding and in your construction. You've got to be doing pretty darn well to be able to afford both of them, 100%. Particularly at your maximum drawdown.
Definitely.
Right. And so unless you're living with family or whichever that helps you with the rental, the new builds, in particularly in established suburbs, we're not seeing as much of that happening. Obviously, in greenfield areas, they don't have a choice because they've got to build housing out there. So, but yeah, I'm definitely seeing with all the costs and construction going on, it's stabilized, which is great. at least we're not looking at consistent rising costs. That's the material shortages have pulled back as well. There's more consistency around that. Labor costs have, I'm not sure that labor costs have necessarily pulled back. They've probably stabilized over the last few years.
Yeah.
And interestingly, the low cost like laborers, right? Particularly in the big cities, and I'm not so much sure how it is in sort of the smaller cities. They don't want to be doing laboring because they actually earn more or about the same driving an Uber car, right? Because you're like, well, am I going to get paid like $30 an hour or $25 an hour lifting a whole lot of stuff in this blistering Australian heat and getting screamed at by my site supervisor, when I can sit in my Uber car with my during Uber in air conditioning. And so you're finding from that aspect, particularly in the I'd say in the lower paid laboring roles, there aren't people there doing that much anymore because there are more cushy opportunities there. So from that front, I can see that things are probably more delayed in some of the bigger cities. Yeah.
I completely agree. I think all of this combined, when you think about this, when you talk about rising construction costs, the material shortages or labor costs, all of this, it makes total sense for people to go down the path of established properties rather than brand new properties, right? But so people are deferring on building unless they really, really want to go down that path, right? And look, I mean, I strongly believe that I don't think that the build prices are going to come down ever. They've never come down. Like people have this weird sort of sense that, you're going to see pre-COVID build prices again. I don't think that that's ever going to be possible. What is going to happen is basically the opposite of the build prices coming down. It's the established properties, which is going to basically catch up. And so when you talk about trends, between established property, which is say 1 to 2 years old versus a brand new property, on average, there would be about 20% difference between the two. I guess established properties would sell 20% cheaper and a brand new property would attract a 20% premium because it's brand new. Right now, that difference is almost 35 to 40% in certain areas. And that's the opportunity for a lot of people where they're aiming for that instant equity due to affordability with an immediate rental. And so they're like, okay, I'm going to come in here, I'm going to do a quick reno, and I'm going to do an instant equity uplift on some of these properties. And the more and more people realize this, the more and more people will start paying premium for established properties and they'll start keep closing that gap. And you can see that happening in Perth. You can see that happening at smaller price points already where people are going in there because the renovation cost is only $50,000 or $80,000 back. Oh yeah, I can do this. But for more expensive renovations where the renovation cost is $300,000, people are still a bit sort of skeptical about, geez, I don't want to do this. But there are major opportunities. I was looking at some of these areas in Melbourne, like Essendon and Keilor. The price discrepancy is like through the roof. I was looking at this particular project in Keilor East where established property was selling at $1 million, whereas fully renovated house was selling at almost $2.5 to $3 million. Same with Essendon. You can buy a property for about 1.5 million, but then there are schmick-looking brand new properties selling at 3.5 to even $5 million, right? That's how big the disparity is, right? And so, of course, there is an opportunity to make money in these markets as well, in these bigger markets as well.
Yeah, absolutely. And that's sort of for the renovators out there. And I know you've had Graham in terms of talking about renovations. There's always obviously a bit of a I was going to say a calculation or a mechanism of going, what is the discrepancy between unrenovated and renovated to be able to identify where those opportunities are for that uplift. And so not everyone can stomach renovations. The dust and the pain of having to deal with trades and so on and so forth. Living with your in-laws for 6 months, but right, you can at the end of it, if you can see the light at the end of the tunnel, then there's good opportunities there, and you're buying it in established markets. You're buying in established markets which have had, you've got that record, and that people are wanting to generally be living in those areas, which more often than not are closer to centralized areas that
Perfect. People can't do renovations, Cheryl, and this is a question for you. For people who can't do renovations, they don't have that big piggy bank of $300,000-$400,000 where they can come in and do massive renovations. Talk a bit about government incentives, right? There is a lot of news coming around that sort of boosting Australians' birthright of owning a home, right?
Yes. So you've got, it's been a long time since I've used all the good old first homeowners grants and deposits and when obviously stamp duty exemptions are still there. But it was for first home buyers, there's so many government incentives in that regard. But even you've got these deposit schemes for single parents as well. Which is fantastic. And then lots of families, I think that's a great incentive there. So many single parents doing it really, really hard and going, how do I get into market to provide some level of certain stability for my family instead of having to. Stamp duty exemptions still are sitting around, but they're not in all the states, are they?
They're different to every state, and I think Victoria and South Australia are the ones where there is very generous stamp duty concessions that are available. They've both taken the threshold out completely for brand new off the plan builds. I think Victoria said 1 year retain. So this year coming up 1 year, any of the planned property that you pick, you don't have to pay stamp duty if you are an owner occupier. Previously, it was sitting at 600,000. And same with South Australia, where they've taken an upper cap out completely and said if you buy a brand new property and or off the plan property, you don't pay any stamp duty. And previously, again, they had an upper limit of 800 or 850. So I think that's pretty awesome, right? And for people, and stamp duty is a big cost when you talk about deposits and everything, right? It can, like, with an average median price in good areas sitting at about $1 million, you're talking about $50,000-$60,000 in stamp duty. If you can save that money and pocket that, why not, right? It just makes total sense for you to go down that path.
Which has brought up, actually triggered a question in my mind about stamp duty in New South Wales, right? So there was all the talk, and admittedly, I hadn't looked this up before this episode. Being able to spread the cost of stamp duty across years as opposed to once off. I haven't seen anything rolled out. Have you seen anything rolled out, Mark?
They gave a choice to owners on choosing whether they want to do a land tax model where they pay an annual fees rather than a stamp duty upfront. And so it was a choice there in Canberra. I think it started off at Canberra, then went to New South Wales. And Victoria in commercial abolished stamp duty completely. South Australia on commercial abolished stamp duty completely and introduced land tax in relation to both of them. So I think directionally they're definitely there. They're going there. And I think evidently it will happen. Everything would be lumped into a single land tax because it's money for infinity as soon as the house is built on the land, right? So it makes total sense for the government to go down that path. I think the problem that some of this has gone back to the back burner is because there is so much debt that these states have raised during COVID that they want the cash flow now. They don't want it in 5 years' time. So they're like, shit, we need the money now so that we can bring the debt down and then bring on some of these long-term implications where we are going to make more money on over a longer-term period. And I think that is why the policy making is slowed down or got on the back burner. But that would come back on the table probably in 1.5 year time, and you'll see states abolishing stamp duty completely and going down the path of land tax.
And that all comes down to that conversation around affordability as well, right? People, average prices in particularly the larger cities, they're way past $1 million now. You've got to raise money for a deposit and a very, very chunky stamp duty bill.
Yeah.
It's not sustainable in that regard.
I think the important thing for viewers and listeners, and especially like people who are trying to enter into this space, is every time when you see some of these news coming out, and if you are in the market trying to get into the market, make sure that you buy it and get on the bandwagon pretty much right away. Because what tends to happen and what I see always happening is a stamp duty concession being introduced, and the bill price goes up and the developer margin goes up, and they eat away all of this, right? I'll give you a typical example. You're finishing off a development. If you're finishing a few developments in Adelaide, but this particular one in Christie's Beach, we were selling them about 560 to 580. And we could have sold all of them when we started hearing news about stamp duty concessions, and they're taking an upper cutoff. I think previously it was 700. So everyone used to try, or 650 or 700. So they used to price it below that so that people can buy first home buyers could buy it. As soon as they took it out, we started getting, our real estate agent basically told us that we should be selling this at 750, 760 now.
Yeah.
And it only took 6 months for us to realize that. But if a person is there who have taken this and knew about these things coming through and entered into the market and signed the deal, all of a sudden they've actually locked in that lower rates, right? So people wait for some of these rules to come through because they're not clear, and they're like, oh, we'll wait for some of this more information to come through. And developers and builders are a lot more astute and smarter these days, and they'll respond to some of these things literally in a matter of weeks. And so if you are in the market, just make sure that you're ready to jump in. Don't go into analysis paralysis mode, right?
Yeah, first mover advantage. All right, the next thing we want to talk about, 2025, what is it looking like for population movement, growth, migration? Where is it starting to really start to show in the major markets in Australia?
I think 2025, the government and all of these news outlets that have been responding to, and all of the data that has been coming out, you're projecting almost 300,000 extra people coming into all Australian major cities. They're talking about Sydney, Melbourne, Brisbane, right? And that's a significant increase, and the housing pressure demand for these people coming through. Now, these are not people who are, and no disrespect to boat people, but you're not talking about refugees. You're talking about people coming in from places like Dubai, Singapore, Hong Kong, UAE. They're cash rich, and they're coming in with deep pockets, and they'll enter into the real estate market because that's what they've been told since they are born, that land is important. You need to buy real estate, right? So these are the type of people that you are looking at entering into this space. And of course, and there is a lot of relaxations that is being provided to them when they are on their work visas. They can still go out there and get loan. They are not permanent resident. They still have an opportunity to get some of these lending available to them. And that's why you hear a immigration minister talking about, hey, we should not let them get loans, and we should block them from getting loans because they are coming in with so much deposit. So they feel that Australia provides such an easy if you think about people coming in from Dubai, right? Or Singapore, right? A single bedroom apartment sells for $1 million there, right? So it makes total sense for them to buy a 3-bedroom or a 4-bedroom house for 800,000. Well, this is cheap as chips, right? So it's a lot of that is on the cards in 2025, and this migration influx is going to put additional pressure on not just on the rental markets, but also the limited supply that is already sitting on the housing market would be eaten up by some of these key drivers of people coming in some of these urban areas.
We're seeing that in some markets, definitely the sort of cash buyers or highly cashed up buyers who are purchasing properties in Australia, because Australia is comparatively a more stable market politically and economically as well. But we're not seeing those busloads of investors, overseas investors coming up, which happened a few years ago, just before COVID actually, around that they were literally coming in and purchasing lots of we're not seeing that as much. However, maybe it's not happening so openly, particularly with your in terms of when you're buying. Are you seeing that do you feel that that will start to happen, but less openly and more through sort of transactions where they're using buyer's agents, where we're doing more of these transactions sort of under the public eye? What are your thoughts around that?
I think a lot of these people, because they are living, you talk about migration, right? Through population growth, through migration, a lot of these people have no idea as to how Australian property market operates, right? So their natural default position is I need to find someone who can help me. And because there are so many buyers agents these days, they naturally default to using one of them in helping them enter into the market, right? So yes, you're 100% right. You see a lot of this activity happening through a lot of buyers agents.
I mean, that begs the question as to whether they're buyers agents, like selling house and land, right? But like I believe that a lot of that is still happening. I do feel that these particularly overseas investors are needing to leverage I want to say expertise, depending on how you define expertise, in Australia. But and the thing is that if they don't, there's a real chance that they are easily swindled because they do there and taken advantage of. And I've seen this even with people that I know. They've got some money, $2 million, or want to buy something. Not doing building and pests, not doing a whole lot of your typical due diligence. And the homeowners are happy because they've got a great price because the overseas buyer doesn't really know what the true value is. And then is left with a lemon. So I think there's this that sort of buying happening. I don't feel that they're in so much droves. We're seeing a lot more of that interstate migration happening still.
Yes.
For so many.
And this is an interesting point. I think when you talk about interstate migration, when you look at numbers, Victoria basically leads the leaderboard right now with interstate migration, where a lot of people are looking at Victoria and coming back to Melbourne because one, it's more affordable, better growth and job opportunities in Victoria. And that's why you hear a lot of people talk about Victoria is not just a place to be. I can say that I'm in Victoria.
Then Sydney.
There's less people than Adelaide right now. Melbourne is the cheapest state, $1 million price point or anything around $1 million. It's the cheapest state compared to any other state. So cheaper than Brisbane, cheaper than Adelaide, definitely cheaper than Sydney.
And if you can handle the weather, the ADHD weather of Melbourne, okay, what are we gonna do today? Then it's a very livable place. And so like I said, we need to look at that combination of where are people going? That data, there's a whole lot of data there. I know you're incredibly data driven in that regard. But yeah, you're going to find that New South Wales is still going to have the highest number of people population wise, but then it's Victoria, then it's Queensland, WA, and so on. Ultimately, people are going to be going, well, New South Wales, lots of obviously the major big cities there.
Yeah.
People are going to want to not necessarily be in that environment.
Yeah. I think the interesting bit is also this, when I was looking at some of the data last week for our upcoming webinar about Australian property landscape, there was one interesting fact that really stood out for me. One, which was when you talk about average livable cost and average family income, Melbourne has a higher family income than Sydney, and Melbourne has the lower livable cost than Sydney. Yet the property prices are lower in Melbourne than Sydney. And so it definitely means that people are in Sydney has much less disposable income left with them. And so they're not truly living. Whereas you go out in Melbourne and you go to food, restaurants, shopping, you see a lot of people, ton of money, right? Whereas you go out there in Sydney and people are still like they're not as expansive and they're going out there and spending money, right? So yeah.
Let's start looking, because at Melbourne again as opportunity for investment. So
Definitely
start to dive into that market there.
Yeah.
Let us move on towards good old rental markets.
Yes. And I think that's a good segue, right? When you talk about rental markets and building pressures and you talk about migration and population growth, all of this is like feeding into the rental market, right? The rental market is where it is because of all of this, right? People have these tightening and low vacancy rates and rents that are growing in double digits. It's happening all across Australia, but the fastest rent increase that you're seeing right now typically in Brisbane and Victoria, we're seeing like almost 8 to 10% rental growth, which is unheard of. On average, rents grow by like maximum of 3 to 5%. So yeah.
Yep. Yeah. And how do you see and with the potential drop in interest rates where we are, do you feel that there's going to be enough in there for our renters to start to go, I think I should be buying property instead of paying all this rent? Do you think there's enough of a discrepancy there?
Yeah, definitely. I think Melbourne market, a lot of people are still sitting on the fence. And so a lot of tenants would definitely jump back into the market. I think people, especially in Melbourne, when I talk to like a lot of Melbournians, their nervousness comes from builders going bust. Know that Victoria is one of the biggest states where most builders are going bust, right? It's not like South Australia, Western Australia, and Sydney where you hear every news every week where some builder is going bust, right? And that's where the nervousness is. People don't want that. Hey, I go out there and buy a house or build a house and my builder goes bust and now I have two loans and a rate and a rent, two loans as in land and the build plus the rent. And I don't want to put myself in that position. I think that's where the biggest nervousness is, where people are choosing to rent. It's not the price. It's not the interest rate. It's that nervousness of people not going
That's
out.
interesting. And so are we seeing then that renters are wanting to stay longer?
Yeah, exactly. And so you are seeing that tenants are staying longer, they're providing more stability, there is less risk to the landlords. And also because the state laws protect tenants quite aggressively as well in Victoria compared to other states, right? There are minimum rental standards that are coming in place and that are upgraded pretty much every 6 months right now. And there are task forces that are catching landlords and property managers and making sure that there are minimum rental standards applicable to each and every property. And so tenants do have a lot of rights in making sure that the rents don't go crazy and all of these amenities are provided to them. And even this, and you can't kick off the outer tenant with a 30 or a 60-day notice anymore. There has to be an explicit reason for you to move a tenant out. And so there's a lot of protection available. And that's why you see a lot of stability in this tenancy market as well. And some of these co-living property demand or dual income property demand in Victoria is basically driven by a lot of what's happening in this space as well.
Do you ever see Australia moving to that model in Europe where there's a larger percentage of renters than there are owner occupiers?
Oh, 100%. Yeah, I think this massive wealth transfer that is happening right now across the world, and everyone talks about this. I saw this number somewhere, and please don't quote on me on this, but it wasn't a trillion number, like multi-digit trillion number. But there is wealth transfer happening from baby boomers to millennials and Gen X, where it would be impossible for people to own a home in 10 years' time, right? Home would basically be part of your generational wealth. And so you would have a choice of just renting. Yeah, definitely. We're definitely going down that path.
Yeah, I think there's a lot, and there's a different conversation around why we feel that's the case. Because I think as well, the generation that's coming up after us, I feel that there's less of the need for ownership of things. There's more of the need for experiences and sort of that shorter term that satisfaction as opposed to the longer term. Well, but then you've got different investment assets and so on as well. Any other things, any other topics you feel that we've missed out before we do a bit of a wrap up?
One of the biggest things that we haven't really touched on, and I think that would be a game changer for 2025, is how are the regulators and the banks responding in 2025? I think that would be one of the big things to look out for. And let's talk a bit about that, Cheryl. Where do you see the Australian banking sector shaking things up?
Well, the banking sector has to be doing something. We were chatting before around, I think the banks are starting to understand and fund asset classes which they weren't doing so before as openly. And we've touched a bit on the co-living space. I know a lot of banks didn't even want to touch that. They used to look at that as commercial properties for a long time, valuing it really quite poorly. That's shifted. You see a lot more lenders in that space, which really bolsters up for investors in terms of the types of properties they're buying. News that was going around yesterday around CBA funding prefab housing, again, an area that the big banks have never been into, but
Yeah.
Kudos to them for recognizing that there's a market in there, but more so for the everyday, I'd say the everyday person and the everyday Australian. We're seeing sort of those interest products, those fixed rate loans or interest only, being stretched out a lot more. We're seeing probably some of the longer loans. Remember, it used to be a 20-year term. Now it's gone to a 30-year term. The product is there to be able to help with affordability. So I think the bank's risk appetite at one point was quite, particularly in the time when we had those consecutive interest rates rises. I think lending was very, very difficult at that point. I think they're realizing, hey, wait a minute, we need to get our clients and customers back in, but we need to do it a little bit differently so that it doesn't affect their profitability, but comes across that we're helping with the affordability for repayments and so on. So yeah, I think the risk appetite is changing and evolving, and they're a bit more open to some level of calculated risk. But what do you think?
I think bank has just way too much money right now in the ecosystem. There's just so much money created after COVID that the bank is like, okay, we need to find more contemporary, non-conventional ways of handing this out rather than just saying, hey, you're offering free money here, take it, right? Because of course there's APRA regulations there, right? And so they need to think about, okay, what new products? How do we innovate? What does banking look like in 2025 for the next 5 years with AI around the corner? I'll share an interesting story here. I saw this video on YouTube where the person was playing with ANZ banking app. In like how ANZ Bank, and for people who bank with ANZ, you usually have to say, my voice is my identity or something along those lines. Stick for you. And so this guy basically was using AI to capture his voice, and then he typed that and put it to the app, and boom, the app basically triggered the transfer. And well, your voice is not your identity anymore. And so there is so much happening in the banking space that the banks are thinking about, okay, how do we make ourselves more risk-proof, but also take enough risk to provide better products out there? And so you're right, that appetite is changing humongously, right? Interest-free loans for 15 years or fixed-term loans for 15 years were never on the cards before. And now we are hearing people talking about it. And interestingly, even super, right? There used to be no banks playing in this space, in SMSF space, lending. And you see so many banks entering into this space. You can get interest-only loans in super. You can get 90% lending in super, like unheard of. Previously, it was like only 70% with only 2 banks, and they would only touch commercial properties, right? So the market is moving so fast with banking regulations as well, and the way that they are responding to a lot of these things. Don't be surprised if refinances in super becomes allowed as well, because hey, the bank wants to hand out more money, right? Or the regulation changes happening there as well. So when crypto is allowed in super and people can buy crypto through their super money, anything is on the cards and anything is possible.
Can happen. I like the idea of being able to refinance in super, because so many people are setting up SMSFs a lot earlier. You're not just talking about the baby boomers and the retirees. Other people are doing that, and so what they're sitting on a whole lot of equity in the meantime. It makes sense to be able to have a product that allows that, so they can build wealth within their super. So I think that would be a really good one. So Moss, I think it's time for us to bring it all home, do a big summary for what it means to our audience and investors out there, and what they need to do to be able to take action with all the information that we've sort of thrown out of everyone. Where do we start?
Look, I'll start at the place where I would say the best money is made when the markets are crunched. And so for people who are sitting on the fence line, they need to take action. This is the time to take action before any major change is happening. Understand that when you talk about market growing or the market growth happening, it's always about more credit available and and people confidence coming back. Those are the only two things. Forget interest rates, forget demand, supply, all of that, all of these crazy jargons that a lot of data scientists use or people handling data uses, right? It's only two things that would drive and dictate the market. One, you have more credit available in the market, and two, consumer confidence coming back. And so you would see that even in times where the interest rates were rising, the property market rose. Okay. And in the times where interest rates were falling, the property market kept falling as well. You could see COVID as well, right? So it's always those two things. And so what is happening in 2025 is both of those two things are happening at the same time, which means that it's a golden opportunity, right? So you have credit availability where the banks are changing the horizon and the dynamics. And two, the consumer confidence is coming back because they're believing that they would have more money in their pockets. And every time that happens, the market takes a turn to the good. So that's where an astute investor should think, and they should not wait to catch the bottom. They should basically go in before the bottom hits so that they can take the full implication of what the top looks like.